23, what was it, 23% something last year that they returned because there were no hurricanes or no major costly ones. Is that right?
Yeah, the cat bond benchmark was up around 20% last year, which was a record return for the asset class. It followed a historic supply-demand imbalance in late 2022, and when 2023 ultimately was unimpactful from natural catastrophes, those record yields were ultimately realized by investors.
That might have people salivating, but a lot of those who've been in the market for some time know that the years prior to that, the returns weren't great. They were positive, maybe a couple of percentage points. Why is that? The storm's just getting more costly?
Yes, so from 2017 through 2022, the U.S. saw a significant number of hurricane landfalls on the coast. So people may remember 2017, Hurricane Irma. Most recently, 2022, Hurricane Ian. 2020 was a record hurricane season. It was the most named storms on record. So those years in the last 5 to 6 years were some of the most destructive and costly within the market, and so that led to this imbalance.
Do you have to have a meteorology degree to take a bet on whether you think we're going to have more or fewer storms? Or it almost, in other words, seems to me like the market is inefficient and it's not pricing appropriately if basically the kind of natural disaster outcome is the bigger impact on returns, or maybe that's just literally how it's supposed to work.
Yeah, so if you go back to the founding of the market, the reason this market was able to come to fruition is that there are probabilistic models that are rooted in science that come out with an annual expected loss probability for a given security. So the way investors have gotten comfortable with this asset class is being able to quantify that risk then allows them to price that risk. And if you look at catastrophe bonds comparable to high yield fixed income instruments, the annual default probability or the default rate historically has been about 2%, which is not that dissimilar than those high yield fixed income instruments.
It's still a small asset class. If we're talking about 35 billion, did you say?
It's about 45 billion today, which is a record high.
Which, again, it's growing, but it's still small in the grand scheme of things. And you wonder, there has to be some financial theory that says a purely uncorrelated asset is a valuable asset to have in a portfolio because everything seems correlated these days, but the weather is clearly not one of those factors.
Yes, so the most significant asset flows into this asset class, because it's a 144A fixed income security, is from qualified institutional buyers, so certain categories of institutions. It tends to be made up of sovereign wealth funds and pension funds around the globe. We've seen some more interest lately from hedge funds, family offices, endowments as yields have reached record high levels, but generally these are very large financial institutions that are putting maybe 1% to 3% of their portfolio to this asset class in order to get that diversification from broader equity and fixed income
markets. What kind of yield could I get these days?
So 2023 yields have come in a little bit from there. We talked about those returns. They're about mid-teens today, which is still a multi-decadal high range for the asset class.
Mid-teens, and that's for what kind of maturity profile? So
the average maturity of a new issuance in the capital market is 3 years. The maturity average for the market or duration for the market as a whole is about 2 years. So there's not a ton of duration risk. There are also floating rate instruments over U.S. Treasury money market funds.
So in other words, if rates have gone up, they should benefit from that.
Yes. So they are benefiting today from about a 5.25% collateral rate, and then the risk spreads at record levels on top of that.